Okay, welcome back to TalkTickers. Today we're diving into the recent earnings results.
Yeah, let's unpack it. It seems like a bit of a mixed story overall.
Definitely. You saw North America showing some real strength, which was good to see.
Right, but then internationally, things looked a bit tougher. Some headwinds there.
Exactly. And that led to, well, a slight dip in their year-over-year revenue overall.
But the narrative they seem to be pushing is really about margin expansion.
Yes, that and focusing on, future growth areas, things beyond just the core.
So looking at the headline numbers for the first quarter, revenue was down, 3% compared to last year?
Yeah, 3% down. Not huge, but still a decrease.
And earnings per share, excluding certain charges, of course.
Came in at 72 cents, so down 3 cents from the year before.
Okay. But that adjusted EBITDA margin, that actually went up slightly.
It did, yeah, up to 23.8%, just a tick higher year over year, but it suggests, like you said, that focus on costs and efficiency is having some effect.
Right, so holding the line on profitability even with lower revenue.
And that North America number really stands out, up 8%.
Yeah, they called out offshore specifically and the data center infrastructure stuff. Seems like that's booming.
It really does. But then you flip to international, down 5%.
And the main culprits there were Mexico, Saudi Arabia.
And a pretty steep drop in Russia, which isn't too surprising given the circumstances.
True. But they did make an interesting point if you exclude those three.
International was actually steady.
Right, and some places even saw double-digit growth. You mentioned UAE, North Africa.
Kuwait, Argentina, China too. So not all bad news internationally.
And despite all that, they're sticking to their plan to return at least, $4 billion to shareholders this year?
Yeah, $4 billion minimum. That's a pretty strong signal of confidence in their cash flow, I think.
Definitely. So let's maybe dig a bit deeper into the different parts of the business. How did the divisions stack up?
Okay, yeah. Production systems, that one looked pretty solid. Steady revenue growth.
They had a really notable margin expansion there, right? Up almost 2 percentage points.
Exactly, 197 basis points.
Yeah.
Huge jump, driven by strong demand for surface production systems, completions, artificial lift.
Plus better pricing and just getting things done more efficiently, it sounds like.
Yeah, execution improvements. And even subsea margins saw an uptick.
Okay, so production systems is a bright spot. What about reservoir performance?
That one was a bit softer, revenue slightly down.
And margins took a hit.
Yeah, margins were impacted by startup costs for some new projects they're launching.
Okay. So investment spending there, did they see any strength?
Well, yes. Strong unconventional stimulation work internationally, but that was offset by less evaluation and exploration activity, kind of a mixed bag within the division.
Got it. In well construction.
Revenue declined there. That tracks with lower drilling activity we've seen in North America.
And those international markets, again, Mexico and Saudi Arabia, were mentioned specifically.
Right. But interestingly, they did say about a third of their international units in that division still grew year over year.
So again, some underlying pockets of strength, even where the headline number is down.
Precisely. Now, the one that really stood out, I think, was digital and integration.
Yes, the digital piece. Revenue grew there.
It did. And it was entirely driven by digital revenue itself, which was up, get this, 17%.
Wow, 17%. So customers are really adopting their AI and cloud solutions.
Seems like it. Looking for efficiency gains.
Yeah.
And that digital strength actually helps offset a temporary disruption they had in their APS projects in Ecuador.
Okay, I saw that mentioned. Cost them about 1 cent in earnings, right?
Yeah, just a penny. But the margins in digital, really impressive expansion, up 380 basis points.
Nearly 4 percentage points. That's significant. It really shows where the value is shifting, perhaps.
Absolutely. It ties into the broader environment, too. They talked about, global economic uncertainty.
And that whole oil supply-demand balance being pretty tricky right now.
Yeah, OPEC plus planning to maybe increase production, but then you have global trade concerns potentially hitting demand. It's a tough equation.
And they're actually forecasting a bit of a dip in global upstream investment next year in 2025.
They are, yeah. Though they think spending in the Middle East and Asia might be more resilient.
So given that backdrop, their strategy seems to be, differentiation.
Differentiated performance, yeah.
Yeah.
Plus, tight cost management, obviously, and keeping those shareholder returns flowing.
They still sound pretty positive on the long-term fundamentals for oil and gas, though, mentioning things like enhanced oil recovery.
And circling back to digital solutions, that seems critical.
What's really interesting is how they framed the digital investment, saying it's starting to decouple from traditional upstream spending.
Yeah, like it's becoming its own separate growth engine, less tied to oil price cycles. That could be huge long term.
A unique opportunity for sure. And it's not just digital within oil and gas, that beyond oil and gas segment.
Right. Carbon capture, geothermal, critical minerals, and those data center solutions again.
They're projecting that whole segment could exceed $1 billion in revenue in 2025.
$1 billion. That's starting to be quite meaningful. And the data center part, driven by AI demand.
Experiencing really rapid growth, they said, both in manufacturing services and those modular cooling units they make.
So lots of focus there. And alongside that, just constantly working on cost optimization, process improvement.
Trying to protect those margins, especially if customer spending gets a bit softer. Makes sense.
Okay, so what about looking ahead? Did they give specific guidance for Q2?
They did. Assuming oil prices stay roughly where they are and no major new tariffs pop up.
Right, the tariff caveat.
They expect Q2 revenue to be flat sequentially, if you exclude the ChampionX deal for now.
Okay, flat revenue. But margins?
Margins they see expanding. Another 50 to 100 basis points, so 0.5% to a full % improvement.
That's pretty good for flat revenue. And for the full year.
Again, assuming similar oil prices, they're looking at the second half revenue being flat to mid-single digits higher than the first half, again, excluding ChampionX.
What's driving that second half growth expectation?
Usual seasonal activity bumps, some new project startups kicking in, and crucially, continued growth in digital and those data center businesses.
And further margin expansion expected for the full year, too.
Yeah, that's the plan. But they were clear tariffs are the big question mark hanging over the margin outlook.
Okay, let's touch on M&A. The ChampionX acquisition. Sounds like it's taking a bit longer.
A little longer than they first thought, yeah. But they said it's progressing. The UK Competition Authority, the CMA, is looking at the remedies they've proposed.
So, still expecting it to close sometime in Q2 or maybe early Q3 2025.
That's the current timeline they're giving.
And on the divestiture side, that Palliser APS project in Canada.
That sale is now expected to close in Q2 as well. So some portfolio tightening happening.
Now back to those tariffs you mentioned. It sounds like a real point of uncertainty.
It definitely is. They acknowledged it. They have some protection, with a lot of international revenue and a diversified supply chain.
But some areas are exposed.
Yeah, particularly U.S. imports of raw materials, maybe for the production systems division, and also some U.S. exports.
So what are they doing about it? Just hoping for the best?
No, they're actively trying to mitigate, optimizing supply chains, trying to get exemptions, talking to customers about potentially adjusting contracts to share the burden.
Okay, so proactive steps, but the final impact really depends on those bigger trade talks, especially U.S.-China.
Exactly. It's a moving target for them.
Did they give any more color on specific regions? Like Saudi Arabia, which they flagged as being slower in Q1?
Yeah, they said activity was down a bit due to production target adjustments by the Saudis.
But they expect things to pick up.
They seem to think unconventional gas will remain a priority there, and they see potential for activity to increase again heading into 2026.
Okay, and reinforcing the digital story again.
Absolutely. They really hammered home that they believe the digital adoption trend in energy is accelerating.
So even if clients tighten belts elsewhere, digital spending might hold up better.
That seems to be their expectation, yeah. Continued strong growth anticipated there.
And their new energy strategy, CCS, geothermal.
All showing positive momentum, they said. Direct lithium extraction, too. Plus, of course, the data center infrastructure angle.
It's becoming a significant pillar. What about cash flow? They mentioned the shareholder returns commitment.
Generated strong cash flow in Q1, and they expect it to grow through the year. That's what underpins the return commitment.
And they've stress tested this. Like, what if oil prices fall?
Apparently so. They believe free cash flow stays robust even in weaker price scenarios, partly because working capital needs would also decrease.
Interesting. And the remaining APS business after selling Palliser, mainly Ecuador.
Primarily Ecuador, yeah. And they described it as functioning more like service contracts now, profitable, and something they expect to hold on to.
Okay. One last region, Russia.
Yeah, they noted a, quote, deep decline in activity there because of how they've implemented sanctions and controls.
And they expect that to continue.
Yes, that trend is expected to persist.
So putting it all together, it really paints a picture of a company navigating, well, a pretty complex, shifting energy world, doesn't it?
It really does. That softer start to the year definitely highlights the uncertainty out there. Supply dynamics, economic factors, it's all in flux.
But that intense focus on margin expansion, even when revenue isn't exactly soaring, that signals real discipline.
Yeah, cost control and prioritizing those higher value segments like digital.
And the digital and data center growth is probably the most telling thing. It really feels like a strategic shift.
Towards areas that are maybe less cyclical, potentially higher growth. It's a smart move if they can execute.
And sticking to the shareholder returns sends a message of confidence, despite the volatility.
Though the Champion X delays do show that big M&A isn't easy right now, especially with regulatory scrutiny.
True. Okay, that brings us nicely to our This Is Not Financial Advice segment. Time for some slightly out there ideas based on what we just discussed.
All right, let's speculate a bit. Purely food for thought, of course.
Absolutely. So here's one thought. You've got OPEC plus talking about increasing production, maybe some demand worries from trade issues.
Potentially putting pressure on oil prices, or at least sentiment around traditional energy.
Exactly. So what if you considered, say, shorting a broad oil services ETF? Betting on maybe some near-term headwinds for that specific sector.
Okay, interesting start. Where's the other side of the trade?
The other side is to go long something focused on data center infrastructure. Yeah. Maybe an ETF tracking data center REITs or related tech hardware companies.
Playing the divergence. Betting against traditional energy services short-term, while betting on the AI-driven data center boom they highlighted.
Precisely. It's a pairs trade based directly on the contrasting trends they discussed. Wild, maybe? But plausible, given the commentary.
I like that. Capitalizing on that potential decoupling. Okay, here's another angle, maybe even more speculative.
Remember, not financial advice.
Definitely not. With their focus on beyond oil and gas, especially carbon capture tech.
Yeah.
And there's increasing global pressure and potential incentives for decarbonization.
Right. CCS could become much bigger down the line.
So what about a small speculative long position in like a pure play carbon capture technology company, or maybe even a company involved in direct lithium extraction, another area they mentioned.
Ooh, okay, so less of a pairs trade, more of a bet on a specific future energy tech that they're also leaning into.
Exactly. It's betting that the broader trend they're participating in will lift these more focused players significantly over the longer term. Higher risk, for sure.
Very high risk. But interesting angles, both of them, stemming directly from the earnings discussion. Remember, folks? Do your own research.
Absolutely. These are just thought experiments.
Okay, so that wraps up our deep dive into these recent earnings results. We've unpacked the numbers, the strategy, the headwinds, the bright spots.
Yeah, quite a bit to digest. The resilience in margins despite revenue pressure, the digital acceleration, the new energy push, lots of moving parts.
What stood out most to you from all this? Or maybe are you seeing similar themes elsewhere in the market? We'd genuinely love to hear your perspective if you want to reach out.
It certainly raises that big question about balancing investment, doesn't it? Traditional energy versus these new tech and energy transition plays.
It really does. A fascinating space to watch, and one we'll definitely keep exploring.
Well, thanks for tuning in to TalkTickers, everyone.
Join us next time as we dissect another key market event.